Welcome to the Farr Cast, bringing you insights into Wall Street, Washington, and the world. And now here's your host, Michael Farr.
Welcome to the Farr Cast. I am Michael Farr. Thanks so much for joining us again this week. It is the 30th day of May. We are 2 months through the second quarter, 1 month away from being half done with 2024. May the 30th is my parents' wedding anniversary. Were my mother still alive, it would be 64 years. And my dad, I talked to him yesterday. He's still hanging in there, 98 and a half or plus, and he'll be 99 in October. So 98 and a half. There we go. Markets have started to pull back just a little bit in the past couple of days. Stocks have given up some ground. The Fed is mincing its words back and forth, trying to sound a little bit more hawkish. We've had Fed governors suggesting that there might be room for another hike because the inflation data are not coming in line as quickly as they would like. Certainly not prepared to say a job is finished. And then we had the Atlanta Fed president yesterday saying, well, maybe by the end of the year, we could sort of start discussing and considering this. That's a far cry from the 7 or 8 cuts markets were looking for in January. As market sentiment grows for Fed cuts, so do market prices. Markets go up when they get more themselves all worked into a lather that indeed the Fed may lower rates. And the Fed hasn't said anything about lowering rates. We keep talking about that on the FarrCast. That doesn't matter. Markets keep trying to spin this narrative, and then the share prices go up, and then the Fed says, we never said that, and then the share market prices come back down. Well, share prices doing that. We're also seeing, I think, a pullback from a recent surge in prices, bit of a pause that refreshes, 10-year Treasury is kind of hanging in there around 4.6%, but we've had a lot of issuance out of the Treasury Department, a lot of issuance, and that has created some weakness. There's been more supply. This is the longest time we've ever had where the 2-year yields have stayed higher than those 10-year yields and not led to a recession. Why? Well, the answer is we're not sure. Markets aren't sure. Economists aren't sure. And I think the most reasonable among this cadre suggest that this is among the unintended consequences of such prolific federal and monetary stimulus. The Treasury Department started sending checks to everybody, and the FOMC, Federal Open Market Committee at the Federal Reserve, lowered rates to 0. So money was free, and that wasn't good enough. They sent you more anyway so that you go out and spend it, and that kept the economy alive. Could that be the reason? Sure, it could be the reason. Do we know the answer? No, we don't know the answer. But a warning sign like this one should be still heeded, I think, with some respect and gravitas, because it ain't over till the fat lady sings. All right. We've now seen something else happening in markets I want to talk about this morning. A little bit of a different FarrCast, I know, today as we cover Wall Street, Washington, and the world. I'm going to get to Washington. Mahaffey is on vacation this week. Can you believe we let him go on vacation? I think it was a mistake, Harry. Shouldn't let him go. Anyway, just keep him working all the time, Mahaffey. Why not? The concentration in the leadership of the S&P 500 has intensified more. Many pundits are waiting for it to spread out. It looked like we were beginning to see strength in other areas coming into the end of last year. In fact, we've seen it a couple of times this year. But right now, if you look at Microsoft, Apple, NVIDIA, Amazon, Alphabet, Google, and Meta, you now are looking at 30% of the S&P 500. 30% in those 6 stocks. Microsoft is 7% of the S&P 500. You think that you're buying a diversified portfolio? 6 stocks, those 6 stocks, yeah. So you think you're getting a diversified portfolio with the S&P 500? Well, you are to an extent, but you're getting 30% of your money, if you buy it today, is going into those 6 stocks. Therefore, what does it mean, Farr? Well, I'm going to tell you what it means. It means that wheresoever go those 6, so go you, baby. That's it. Where's go those 6, so go you. You are the 7th horseman out there, right? So I was asked by Brian Sullivan on his show the other night, hey, Michael, let's have fun with a question. This is online, folks. In a battle between NVIDIA and the Federal Reserve, who wins? And I said, yes. And we laughed. And then I explained that you can't beat the Federal Reserve when they start to stomp on the brakes. If they decide they're going to raise interest rates, you can't beat that. So don't fight the Fed. You've heard it so many times. The Fed controlling the price of money can control a lot of that and influence. Peter Lynch from Fidelity Magellan said, earnings growth is the most significant indicator of stock price performance over time. Period. Earnings growth is the most significant indicator of stock price performance over time. So this company right now has hot earnings growth. Could that change? Sure, it could change. Okay, shifting gears. We're watching this battle between whether the consumer has money to continue to consume to drive economic growth and also inflation, right? You need the consumer to keep spending to drive inflation most of the time, because when it comes to the housing market, we know of supply and demand, and housing is still in short supply. So housing prices have continued to rise. The rise has decreased. The rate of increase has decreased. So they're rising slowly, and it's neither really a buyer's nor a seller's market at this point. So maybe that means it's topping out. If the Fed lowers those interest rates and mortgage rates come down, that'll be big, and that could get that housing market hot again, and the Fed doesn't want that. So we know we've got a bunch of things going on in interest rates that are muddying the picture. One is we've had a lot of supply on the short end. And if you read Kenny Polcari's note today, you'll see that there's been a lot of supply on the short end, that Secretary Yellen has to finance a lot of the debt that's expiring. Yesterday's auction was a 7-year auction. It's always a sloppy auction. It's always a sloppy auction, and sometimes it can surprise you. But most of the times, when I say sloppy, and when you hear about a sloppy auction, it means not good. A tight auction means that they got the debt out there, and markets seem to show consensus that the rate was the correct rate. Wide spreads mean that there weren't quite as many buyers as they wanted, and there was a gap in those auction prices. That gets sloppy. That's not a healthy sign of rates going lower. That's more of an indication that rates could go a little bit higher. All right, I'm going to shift quickly to politics, and then we're going to get to talk to our friend Kenny Polcari. He's joining us this morning on this special edition of the Farr Cast. As we look at politics, we certainly have this trial in New York, which seems to be a big distraction overall. If you go through the legal arguments, ladies and gentlemen, I am no fan of President Trump. I am not a fan of President Trump as a human being. I think he's an awful human being. There. Did he do some good things as president? Yes, I think he did. Yes, I think he did some good things. I think he did some stupid things as president too. I tend to feel that way, by the way, about most presidents. If you really look at what they do, there's stuff that I agree with and stuff that I don't agree with as to what they do. But the premise for this particular trial in New York, the kind of gross sex stuff aside, there's not a good legal, clear argument for what they're trying to do. We'll see how that plays, but so far it's been benefiting President Trump in the headlines. Here's the big issue for this upcoming election. I looked at President Biden last night as he was speaking. This man is really elderly. I would not want him running my company. I would not want him as my CEO. I would not want Joe Biden as CEO of NVIDIA, IBM, McDonald's, or anything else, unless I knew who the number 2 was, and they better be damn good. So I'm not happy with where we are politically. But the big issue for a lot of folks out there, and particularly wealthy folks, is that 2017 tax cut and the estate tax exemption that's going to expire in 2025 unless it's extended by Congress. This is a big, big deal. Financially, it's a huge deal. Right now, the estate tax exemption is about $12 million per person and $24 million for a married couple. You can have an estate of $24 million. You get a stepped up basis on everything to $24 million for Fred and Ethel. Fred and Ethel done well with that apartment building in the Bronx, huh? Yeah. $24 million and not pay any estate tax. Not pay any estate tax. It looks like it will revert back to $6 million per person and $12 million per couple. There are a lot of estates in that range that will end up with several millions of dollars in an estate tax bill for all of those families that wouldn't otherwise have one if that gets extended. So people are thinking, I'm going to vote for President Trump because it's in my economic interest, and always pay attention to the economic interests. All right. Finally, the consumer, the voter, still feels like they're suffering from inflation. That's a problem. If they don't feel good, they're not going to vote for you. It's really simple. If they don't feel good, they're not going to vote for you. They're making more money. Their wages have kept up with inflation, but they just kept up with inflation. They have not outpaced inflation, and the debt is racking up. So when the consumer gets squeezed and they don't have anywhere to go, they find somebody to blame. Right now, the guy in the chair is Joe Biden, and unless he can tell this story any better, if he can't find some salespeople to go out there and spin it, I think you ought to call Polcari, actually. Polcari could sell. But I'm telling you, Kenny Polcari can talk a dog off a meat truck. He's the guy I'd got. Joe Biden, you should call Polcari. Anyway, the economy is okay. The economy is growing. We have a too fast growth problem that the Federal Reserve is trying to sit on and squelch. I think they're doing a decent job, but we also have a weakening consumer who does not feel that he is better off than he was 4 years ago. Joe, buddy, you have a problem. Okay, folks, we're going to take a quick pause. We're going to come back with Kenny Polcari, Chief Investment Strategist for Slatestone Advisors, and he's one of my best friends. When we come back on the Farr Cast, please stay with us.
Michael Farr and the Farr Cast are proud to support Heroes, Inc. Heroes supports the spouses and children of law enforcement officers and firefighters who gave their lives in the line of duty to the greater Washington, D.C. community. Their singular goal is to honor the supreme sacrifice made by these individuals by caring for their families. Heroes' work begins within 24 hours of the tragic loss and continues indefinitely. We invite you to learn more about Heroes' mission at heroes.org. We hope that you will consider supporting Heroes as they endeavor to honor those who protect us. That's heroes.org. Heroes, here for you, here for good. And now, back to the FarrCast and your host, Michael Farr. Welcome back to the FarrCast, and now here's your host, Michael Farr.
Welcome back. Joining me now, as promised, ladies and gentlemen, the one, the only, the great, the magnificent, the marvelous wizard, Kenny Polcari, Slatestone Chief Market Strategist, and Case Capital Advisors CEO, in charge of Fox News. Kenny, welcome back.
Thank you, Michael. It's always a pleasure to be here. How are you?
Well, I'm doing great, Kenny. Markets are pulling back in here. Treasury's trying to get through what they're trying to get through. Investors are trying to sort through all of this noise. Tell us what we should do. I read your note today. Thought it was very good.
Yeah, so listen, I bring up in my note today that nobody should be surprised. First of all, because at the end of last year, we knew what Janet Yellen was going to need to do. We knew she was going to need to bring more supply to the market. We talked about it. We talked about what potentially meant when she brought it. Would the buyers be standing there? Would they be able to scoop it right up? Or were they going to be a little bit more discerning and step back? Were they going to stand in front of a moving train or not? And what we saw this week was they decided to kind of take a little bit of a step back. So we saw, doesn't mean that there's not buyers for our debt. There are plenty of buyers. It's just that what are they willing to pay, right? And so what we saw was they're willing to pay a little bit less, sending yields a little bit higher. And that kind of has created some anxiety in the markets. But again, We talked about this. Nobody should be surprised that this is happening. Now,
well, okay, they
happening,
might
it's
not be
unnerving.
surprised, but I mean, they're not happy that the day is here. I mean, I got a colonoscopy coming up, and I'm not going to think about it. But that day before, whether I want to think about it or not, I mean, it's not like I'm going to celebrate it.
No, and that's exactly right. So we knew it was coming. So mentally, they knew it was coming. But the day it actually comes is the day it creates all this angst, and that's exactly what we see.
Colonoscopy creates more than angst. Go ahead.
So let's stick to stocks at the moment, all right? But it creates a little bit of angst. But look, the market has not collapsed by any stretch. So what have we sold off? We've sold off 3% across the Dow, maybe 2.5% in the S&P. We're not falling out of bed yet. But I think what people have to understand is they have to watch now. What's the Fed going to do now? What's the next thing that Janet's going to bring to the market? What's the next CPI and PPI report going to be? Because look, tomorrow we're going to get the PCE, which we know is the Fed's favorite inflation gauge, right? But remember what happened 2 weeks ago. PPI came in much harder than expected, which means that next month's CPI, because it takes about 4 or 5 weeks for it to filter its way down to the consumer, I don't see how the June reading in CPI in 2 weeks, I don't see how that can be trending lower after the hot CPI number. So I think we're going to start to see CPI turn up again.
Hang on 1 second. Fred and Ethel, PPI, Producer Price Index. These are the prices that are reported by producers that they have to pay. So think about all of the manufacturers out there who are making everything from tires to hamburgers and have to buy raw materials or stainless steel pipe or whatever it is, copper wire, and they have to pay for all that stuff. So when they have to pay higher prices, sooner or later, they're going to take that, and it takes a little while to grind through, but you call those, when you study economics, those are input costs. And when that hurts the margins of those manufacturers because they got to raise their prices. And when they raise their prices, then you see that in the CPI, the Consumer Price Index. All right, Kenny, go ahead.
Right. So that to your point, it takes 4 or 5 weeks for it to filter its way through. So while tomorrow's PCE report, because here's what I'm thinking, they're going to try to set up tomorrow's PCE report to show that, it's the slowest increase that we've had in over a year. So that's a positive. So the Fed's in a good place. So the Fed's got to cut rates. Well, watch what happens next month to the CPI, because then I think you're going to see that PPI turn into the CPI, and the CPI is going to start to rear its ugly head, and it's going to create all this angst again in the market. So all that means is you have a plan. You have an advisor. You've got a well thought out, diversified plan. There's no reason to panic unless you're way, way out in the risk scale. But your clients and my clients are not those people way, way out in the risk scale. And so they just need to get comfortable with the fact that you and I are watching out.
Yep. You and I are watching out, and together with our clients, we have a plan.
Correct.
And look, folks, when risk is the order of the day that is leading the charge, and where the really exciting stuff is staying really exciting, you need to stick with your plan. You have a plan to get you to your retirement goals, to funding, to make sure that you can pass on some money to your next generation, or at least stay solvent through your last breath. All of those pretty good goals. That's what has to happen. You don't have to beat your brother-in-law, okay? You don't have to beat your brother-in-law who told you he just bought XYZ stock, or he bought NVIDIA 2 weeks ago, and now he's up 15%, and you're an idiot for not doing that, or bought it 6 months ago, or bought name of stock here that is now through the roof, because they don't tell you about the ones that drop. Your job is to make sure that your account takes care of you the way you need it to for the rest of your life. And if we have to save and add to it, what we need to do is not lose. Let's keep it moving in the right direction here. So, Kenny, as we look at the balance of the year, we've got a couple of different big investment houses with very different predictions, right? Very different predictions. Talk about some of the big disparities in predictions. Morgan Stanley, go ahead, you do it.
Yeah. JP Morgan's got a 4,200 target on the S&P, while Bank of Montreal has a 5,600 target on the S&P. That's a very, very wide dispersion in terms of where people think we're going to be, right? JP Morgan, has been very cautious. Jamie Dimon has been very cautious.
So JP Morgan's looking for 4,200
on the S&P. That's their estimate.
S&P. And Bank of Montreal is looking for
5,600.
5,600.
Right now,
S&P 500 is 5,300
two,
or so,
it's at
52, 53.
52.66 last night. But remember, 2 weeks ago, we were kissing 54.50. So 5,600 looked like it was going to happen, in the next month. Now suddenly 5,600 doesn't look like it's going to happen
Okay,
as
but
quickly.
if we go to 4,200, that's a 20% drop by December.
That's correct. It's a very ugly drop. There's no doubt about it. Now, I think that's a little bit dramatic. I don't think we're going to 4,200. That's well below the long-term trend line. That would be listen. If we go there, then then there's going to be a lot more to talk about. But I don't think we're going there, right? I think if we test at the worst, the 200-day moving average, which is like 47.50, I think, or 47.60. I think that's where we go, and I think we're going to grind there if we go there. I think we're really going to be somewhere in between that one and the intermediate, which is like 5,000, 5,100. I think we're going to be somewhere in between there. We're going to churn for a little bit over the summer. We're going to see what unfolds with the election. We're going to see what unfolds with the economy, and then we'll figure it out. But
you worried about this election? Are you worried about this election?
I'm worried about the election more so because I'm worried about what the reaction is going to be on either side. If Trump wins, what's the reaction going to be from the far left? If Biden wins, what's the reaction going to be from the far right? That's what I'm worried about. I'm more worried about there being civil unrest. I'm not worried about it in terms of what do I think the economy is going to do. Yeah, do the Democrats have tax and spend policies that aren't very helpful? Sure, they do. I get it. But if we've got a divided Congress, then it holds everybody in check, right? The worst thing that could happen is we get a complete Democratic sweep, and then they're once again in control, and then they start spending money like there's no tomorrow. If you have a split Congress, then there's some checks and balances. It doesn't really happen that quickly, and that's probably when the market functions the best, when there's a split Congress, because
doesn't look like there's going to be. There are a couple of rather scientific polls that came out, but one in particular last night that said the odds now of a Trump victory, number one, and a Republican sweep, number two, are both higher than 50%. Trump victory much higher, and a Republican sweep, which gives a lot of control and a lot of change. I got to tell you, Kenny, I'm looking at the consumer, and I'm watching the consumer. A couple of weeks ago, you saw Home Depot say that the ticket prices were getting smaller and fewer, and they're trying to focus more on pro. Lowe's too, same thing. Home Depot looking for a smaller pro, I think, than the Lowe's pro. I think I might have that reversed, but doesn't matter. It isn't coming from the individual. We saw some of the fast food restaurants say that they are seeing a decline. We have Best Buy out saying that they had another quarter of sluggish consumer electronics demand. Kohl's, the retailer, down 20% this morning after a big earnings miss. And a lot of sales are beginning. Big slashing markdowns very early in the season now out of Target.
Right.
All of these retailers responding to a weaker consumer. If the consumer is finally running out of wallet, that will put the economic brakes on faster than anything the Fed can do, I think.
I think the consumer is tiring of the higher prices. I'm not necessarily sure that I think they're running out of wallet. There may be a certain sector of the economy that is, but I think people are they've had it with these higher prices, and so they're going on strike. They're just walking away. Not that they can't. They just decide I'm not doing it, right?
Okay.
And so you end up in the same place, because then Target and Kohl's, everyone has to have these sales in order to draw them back in, which they will do, right? They'll put stuff on sale, and you'll see how fast people go running back in.
Savings rate has really plummeted, though. Savings rate is really low now.
Well, it's funny. One day they say it's really low. The next day they said, oh, the consumer's never been stronger, and blah, blah. And so where is the savings rate really, right? How do you really, it depends on whose number you're looking at. But to your point, I do agree with you. I think people have been under pressure, for sure. Higher prices have taken a toll. But I think right now people are just disgusted with, they're just tired of the higher prices, so they're almost going on strike. That's what I think is happening.
Certainly fatigue and the emotional side of being a consumer. We talked about it in my first segment. If you don't feel good for right now economically, you're not going to vote for the politician in charge. Doesn't matter who it is. And also, if you don't feel good right now, you're not going to spend. You spend when you feel good. That's when
Right.
you spend. When you feel bad, you don't. It's really,
That,
really simple. And
yep.
when you feel uncertain and unsure, you don't spend. And there are economic studies, behavioral economic studies that bear this out. The old example of buying the refrigerator. I tell you that energy prices are going up and the economy is going to get tough next year. You'll buy a less expensive, more energy efficient refrigerator if you need to buy a refrigerator. If I tell you that the economy is going to get better and energy prices are going to stay low next year, you'll buy the double door thing with the water and the ice through the door and the see-through everything, bells and whistles, and spend more money. If I tell you things are going to change dramatically next year, and I'm not sure whether they're going up or down, or energy prices could be very volatile, let me tell you what you're going to do. Economic reports and studies over decades show that you are not going to buy a refrigerator. You're going to postpone that purchase of the refrigerator until you get visibility and can feel better about it. Kenny, final word for this segment. What should we do?
No. So I think the last thing you need to do is make an emotional decision. Don't get drawn into this fray. If you've got the well-diversified portfolio, there is going to be opportunity. We're going to see cheaper prices, put new money to work there. Until then, leave that new money in a money market or cash account that's earning 5.25%, because that too is an investment decision at the moment. So I think the worst thing you can do is make an emotional decision, and that's why guys like you and I stand in the way and try to prevent people from doing exactly that.
Got to keep folks remaining calm. Remain calm. Keep moving forward. Listen to the Brits. They kind of have that part of it right. Steady as she goes. Yeah. Kenny Polcari, Chief Market Strategist for Slate Stone, Case Capital Advisors CEO, my great friend. Thank you, Kenny.
Thank you, Michael. Always a pleasure.
Thanks. That's it for another special edition of the Farr Cast, where we cover Wall Street, Washington, and the world. We'll be back again next week. For my producer, Harry Jennings, everybody at Hightower and Farr Miller in Washington, thanks very much for joining us. We appreciate it a lot. Hope you have a great weekend. I'm Michael Farr. See you next week.
Thanks for joining us on this special abbreviated edition of the Farr Cast. And thanks to our guest, our great friend, Kenny Polcari. The Farr Cast is produced by Michael Farr and Harry Jennings and comes to you weekly for free on all major podcast platforms, including TuneIn, Apple Podcasts, and Spotify. You can stream past episodes as well as subscribe so you never miss a new one. Please be aware that any time we or any of our guests mention a specific company, sector, or refer to performance in relation to an earnings report, a news headline, or an economic trend, it's not a recommendation to buy or sell. Review the risks and rewards of any investment with your financial advisor for what specific investment and general strategy is appropriate for you before you make any investment decision. As always, if we can be of assistance at Farr Miller in Washington, please reach out to me at hjennings@farrmiller.com. We are here to help, and I'm happy to arrange for any of our listeners an appointment with one of our financial professionals to review your portfolio, your needs, and your goals. As we continue into the summer, we will look to still bring you weekly updates on the evolving markets, economy, and world, and try to explain more of the investment universe. Next week, our scheduled special guest is Darrell Owen, who will give us deep insight into the energy economy and how it relates to politics, policy, and your portfolio. Take care, stay safe, and stay healthy. Thanks for listening to the Farr Cast. Wall Street, Washington, and the world. Farr Miller in Washington is a group comprised of investment professionals registered with Hightower Advisors, LLC, and a SEC-registered investment advisor. Some investment professionals may also be registered with Hightower Securities, LLC, member FINRA and SIPC. Advisory services are offered through Hightower Advisors, LLC. Securities are offered through Hightower Securities, LLC. All information referenced herein is from sources believed to be reliable. Farr Miller in Washington and Hightower Advisors, LLC have not independently verified the accuracy or completeness of the information contained in this podcast. Farr Miller in Washington and Hightower Advisors, LLC and any of its affiliates make no representations or warranties, expressed or implied, as to the accuracy or completeness of the information or for statements or errors or omissions or results obtained from the use of this information. Farr Miller in Washington and Hightower Advisors, LLC and any of its affiliates assume no liability for any action made or taken in reliance on or relating in any way to the information. This podcast and the materials contained herein were created for informational purposes only. The opinions expressed are solely those of the authors and do not represent those of Hightower Advisors LLC or any of its affiliates. Farr Miller in Washington and Hightower Advisors LLC or any of its affiliates do not provide tax or legal advice. This material was not intended or written to be used or presented in any way to any entity as tax or legal advice. Clients are urged to consult their tax and or legal advisors for related questions.